This is the Diary of an Apartment Investor podcast, and I'm your host, Brian Briscoe, coming to you with another multifamily brief episode. So today's going to be a little bit brief like they all are. But anyway, a couple things I wanted to talk about. It's one of these things that's kind of interesting when people forecast what's going to happen to the economy. I heard somebody say it, and I completely agree with the sentiment. They said that the next recession has been the most forecasted recession coming in the history of all recessions, right? So when you start looking at what forward-looking data does, people are just trying to guess on what's going to happen. Oh my goodness, we're going to have a recession. I think we started hearing that definitely over a year ago. The yield curve, something people typically use to predict recessions. The yield curve became inverted about a year ago. And basically what that means is the sentiment on the short-term economy is not good, and people have a lot more faith in the long-term economy. So short-term interest rates go up relative to long-term interest rates because people, like I said, people have more faith in the economy over the long term than they do in the short term. And so it is a very good indicator of recessions. And, most people look at the very high correlation between that inverted yield curve and recessions. But, who cares about that? All right. A lot of economists have been predicting recession for quite a while. I remember a year ago, we had negative GDP growth for a couple of quarters, which is only part of the definition of a recession. It kind of has to be in there for a recession to occur, but it's not the only thing that has to happen for a recession to occur, right? So it's kind of like, one out of three conditions were met, So anyway, why am I talking about this? Well, just looking through the Wall Street Journal today, and it's Tuesday, July 18th. This episode is going to air Wednesday morning, but there's a couple of articles that are talking about, well, maybe there's not going to be a recession, or maybe we are going to get that soft landing, or a lot of economists are changing their forecasts, and they're saying it's going to be a much milder recession, or the recession is going to start a lot later than we had previously predicted. So bottom line, you can't predict stuff like that accurately, and there's probably just as many people who predict wrong as people who predict right. And ultimately, what I started seeing a year ago when rates started going up and everybody was talking about recession, was a lot of people went to the sidelines. They stopped buying, and for a little while I did too. But I mean, quite frankly, I think my hiatus in buying was because I was leaving my previous company. End of the day, I would have kept on buying, but I was in the middle of, a little bit of a breakup. And a lot of people were pointing to the upcoming recession and rates and instability in the market and everything else. And hence, a lot of people just didn't buy. Right now, what do you think about that? Well, it depends on your time frame. It depends on how far forward looking you are. Now, if you're looking at taking an apartment and doing a really quick value add and selling it in 12 to 18 months, okay, yeah, last year, probably a good time not to buy, but if you have a much longer view in mind, yeah, you should have kept on buying, kept on buying. And a year ago, I mean, it's July right now. A year ago, interest rates were 2.5 points lower than they are right now. And people were crying, complaining about, oh my gosh, interest rates are in the high fours, or, oh my goodness, the new loan I'm getting is like a 5%. Right now, Fannie and Freddie loans are in the low sixes. Anyway, it's a lot different. But long story short, I think looking at economic data and predictions, you need to be careful when looking at that, and you need to make sure that you have a long enough horizon and you have enough flexibility built into your deals to be able to hold a little bit longer if you have to. And a lot of the people that are in a little bit of trouble right now have short-term loans. They didn't have the ability to flex a little bit. And so when rates went up really, really quickly, they were sitting in a position where like, oh my goodness, we can't sell without losing money, and we can't refinance without putting more money in. So, ended up being a lot of people, a lot of operators, and a lot of investors being in a very bad position before it. So something I think about a lot is I look back to my very first single family home purchase. I bought a house in 2007, and it was August of 2007, and the real estate market, started crashing, basically October. The stock market crashed, I think, end of October. And it was probably the worst time, if you're looking at home values, it was probably the worst time ever to buy a house. But had I gone back to that exact time and exact place and made that decision all over again, knowing that the market was going to crash, I still would have bought that home. It was something that we intended to buy and hold for a long time. And when we bought it, the tenants that we put in paid the mortgage. So we were breaking even every month. On an annual basis, we were breaking even, sometimes into the positive cash flow. But end of the day, we held that property for several years. And when we sold it, we made a ridiculous ROI on our money. I mean, partially because of the amount of leverage we got. I think we got a 100% loan with just a little bit of money down. So we turned like $3,000, $4,000 into like $104,000 or something like that. So our return was, fantastic. But had we been more leveraged, the numbers wouldn't have been as outrageous, but we still would have done extremely well. So looking right now, had you bought last year, okay, right now the prices might be a little bit lower than, depending on where you're at, the prices are probably a little lower than where you purchased last year. But, once again, if you have that long enough hold period, if you're looking to hold 5 or 8 or 10 years, the most likely scenario is that prices are going to rebound. They're going to go up and up and up. And 3, 5, 7 years from now, you're going to be sitting on top of, an appreciating asset with a lot of equity into it. So you may not hit the types of returns that people were getting in 2021, 2022, where, or early 22, where after a 12-month hold, you were doubling your equity, but there's still going to be solid returns for a long, long time. So anyway, just a little bit of a dose of confidence. Doesn't matter where in the economic cycle you buy, as long as you have enough of a runway to weather out potential storms. And I know that's two different analogies, runways, taking off, and storms, whatever. But anyway, that's it for today. Hope you guys have a great day today, and we'll talk to you soon.
Hey, if you like that episode, make sure to subscribe. But more importantly, if you haven't joined our multifamily educational community yet, which we call the Tribe of Titans, you are missing out. Get 30 days free by clicking the link in the description to this episode, or go to thetribeoftitans.info, and we'll see you there.